Central banks, of course, in focus with the Fed decision dominating discussions. The Bank of England next, of course, with their policy meeting. Let's discuss the implications with Peter McGuire from XM Australia. So, Peter, let's just start with the Fed and I guess what you thought there from Jay Powell's commentary as well. I mean, he mentioned people hate inflation. We know that, but it does seem like it's sticky and that these higher rates are here to stay.
Well, good morning, Juliette. Yes, lovely to see you. And building on what Jonathan just mentioned, great overview as far as the commodity sector and what's on board as far as energy prices. They're one of concern for Fed Chair Powell and naturally every central banker. So as we wrap that all up, we saw a nice move to the upside for US dollar. Equities came off, they were sold out. And I think that there's probably the best part of another 25 by November. That seems to be where we're all sitting. And there were no surprises. I think if you listen to the rhetoric, everyone was pretty sure of, that was going to be the status quo, and it's going to be a softer stance from the Fed next year in the sense of not as aggressive from a rate pulling them back. So, I think we're in for this, as he's mentioning, stronger for longer.
We're also looking in terms of what we're going to see from the Bank of England, who are up next. We've got the Bank of Japan this week as well. It's a very tricky scenario at the moment for central bankers. What kind of, movement are we going to see from the BOE given what we're seeing in terms of some of these energy prices and heading into the Northern Hemisphere winter?
Well, everyone's saying that you probably see another 25 there, building on what they did last week with the ECB, Juliette. So that seems to be pretty much the status quo. And where we're looking in the sense that the pound has been sold off and it's coming under pressure is still at around about 1.23. And they're really in a little bit worse position than probably the ECB are, or in the sense of the Eurozone as far as growth and the impact inflation's having to the UK, and economically they're quite challenged at the moment. So yeah, it's going to be interesting how they roll with that as far as very sticky inflation, and that's a major concern for their policymakers.
Yeah, we're looking as well in terms of what the PMIs are going to tell us and what that means for future ECB moves as well. You mentioned the ECB there. What are you reading in terms of the PMIs?
Well, we got those coming out tomorrow for the Eurozone, and that'll be, I've just made some notes on that. I mean, everyone's focused because that tells us we understand the position with Germany and the economic powerhouse that it is, and the overall, consumption internally and domestic demand and global demand for finished products coming out of the Eurozone. So with a weak global market, then that's going to cause concern naturally moving forward to the PMIs. And we've just got to work through that and see not only activity domestically, but how the globe's moving forward to buy those finished goods and German motor cars and all of those lovely things made in Europe.
Of course, it very much focuses in on what we're seeing in currency markets as well. I was talking earlier with Jonathan about the dollar and the impact there to the metals market. But if we look at the euro as well, I mean, its next leg also depends on what we see from the ECB and from the Fed staying higher for longer. What sort of traction are you seeing for the euro?
Well, you're looking at around about that 1.0630 at the moment. It's pretty hard to, with the rate rise last week on the US dollar index, that's weighted at around about 61% for the viewers out there, 61% in euro weighting. Well, it's now sitting at 105.6, and there's every chance you could see a 106 handle. It really ratcheted up very aggressively in the last, the best part of 12 hours, maybe even 8 hours. So it's been quite strong, and obviously we're going to see further weakness, I think, for the euro. Maybe a 105 is the next line in the sand, Juliette, and we'll just have to see, where it gains traction after that.
Indeed, and of course the other key focus for investors has been very much what we're seeing in bond yields, and you could argue the 2-year is incredibly important too. What are you seeing in terms of the yield movement, particularly when it comes to equities as well, because tech stocks wobbling a little bit on these higher yields?
Yeah, exactly. That euro, the Nasdaq off 1.5% overnight, and it's concerned, the price of money and all of those impacts as far as CFOs' nightmares. If you're looking at US stocks, the old story, S&P is deriving 40% of its income outside of America, and the Nasdaq's around 60%. So it is dependent very much on their export markets and global demand. So with the cost of money and how the rates are looking over the next 60 to 90 days leading up to Christmas, then I think that's going to cause again more of a handbrake to equity growth, and we've just got to sit through that and see the impact it has.